Warm greetings from Kamadhan Arts and Science College. I, Dr. M. Prakash, Associate Professor, PG and Research Department of Commerce CA. Now we discuss one of the topic from the banking and insurance law. Principles of insurance. First of all, the meaning of insurance. Insurance is a contract, a legal agreement between the two parties. The individual named insured and the insurance company called as the insurer. In this agreement, the insurer promises to help with the losses of the insured on the happening of contingency. So the insured persons, on the other hand, pays some premium in return for the promise made by the insurers. And next, the important principles of insurance. The important principles are: first one is the utmost of good faith, then second, the proximate cause, then insurable interest, then indemnity, then principle of contribution. Now we discuss one by one. Utmost good faith. The fundamental principle is that both the parties in an insurance contract should act in good faith towards each other. They must provide clear and concise information related to the terms and the conditions of the contract. However, the insured should provide all the information related to the subject matter. Then the insurer must give precise details regarding the contract. This is the utmost good faith. Then second principle, proximate cause. This is also called as the principle of causa proxima, or the nearest cause. How this principle applies: when the loss is the result of two or more causes, the insurance company will find what is the nearest cost of loss to the property. If the proximate cause is one in which the property is insured, then the company must pay the compensation. If it is not a cause the property is insured against, then no payment will be made by the insured. Then third principle, insurable interest. The insurable interest is one of the type of investment that protects anything subject to a financial loss. A person or entity has an insurable interest in an item, event, or action when the damages or losses of the object would cause a financial loss or other hands. The insurable interest also extends to the direct dependence and relationship of blood and marriage. Then fourth principle, this principle, indemnity. The principle says that insurance is done only for the coverage of the loss. Hence, insured should not make any profit from the insurance contracts. In other words, the insured should be compensated the amount equal to the actual loss and not the amount exceeding the loss. So the principles of indemnity is observed strictly for property insurance and not applicable for the life insurance contracts. Then finally, the principle of contribution. The principle of contribution applies when the insured takes more than one insurance policy for the same subject matter. It states that the same thing as in the principle of indemnity, the insured cannot make a profit by claiming the loss of one subject matter from different policies of companies. A property of worth rupees 5 lakhs is insured with a company A for rupees 3 lakhs and B with company rupees 1 lakh. The owner is also liable for only one company. For property of 3 lakhs can claim the full amount from the company. He cannot claim from company B. Even the principle of contribution is once again a property worth of rupees 5 lakhs is insured with a company A for rupees 3 lakhs with a company B for rupees 1 lakh. At the time, the owner only liable and claim the full amount from A or B, not two companies in one time. This is the principle of contribution. Thank you.